So good evening everyone. Terry Case is my name. I'm an accountant here based in Carrick-on-Shannon. We worked as myself and 5 more worked in the practice. We deal with a wide range of small to medium-sized enterprises. And Johnny contacted me on behalf of the local enterprise office to see what I do a presentation on the pros and cons of operating from a sole trader to a limited company. So we said we'd put our heads together in the office and put together a presentation on, I suppose, the practical issues that we come across on a daily basis in dealing with clients. So I'll just start the presentation. They are available for you at the end because they are pretty comprehensive. So it's on a soft copy. So the first area I'm going to look at is in terms of an issue number one is business growth. Your decision to transfer a business to a company should be based on sound commercial reasons and not short-term tax savings. It's not suited to every business, a company, so it depends on the type of business. The critical issues that we come across on a day-to-day basis if we're dealing with clients, either a new client setting up a business in making that decision to incorporate or remain as a sole trader or a partnership, or as an existing sole trader deciding to incorporate. So how much is the business going to grow? If your turnover is going to grow, say, from 0 to 800,000 in 12 months, with profits of, say, 300,000 and continue to grow rapidly, then it makes sense to have profits taxed at 12.5% corporate rate. If the business is fairly stagnant and turnover is of 50,000 with little growth, it makes sense to leave it as a sole trader business. B, use of losses. Would you be better off using initial losses against your personal sole trade income rather than have initial losses carried forward for relief against future profits of the company? Again, that decision needs to be balanced against the protection of limited liability. Another area is C. Do you intend to leave profits in the company or pay them out regularly in the form of a salary or dividends? Again, if you intend to extract all of the profits from, then these profits are going to be taxed up to 41% in the hands of the shareholders. If you do not intend to extract all of the profits, the company can be used as a savings box to build up funds for new business ventures. Such retained profits are not liable to surcharge, as in the case of retained investment or rental or service company income. So it depends on the type of activity that the company is involved in. Another key factor in determining setting up a company is the level of drawings. Like, you'd be familiar with that. People that's a sole trader here would be familiar with drawings that are taken out of the business. Transferring a business to a company can save cash flow if your drawings are significantly less than the company's profits. In other words, if the profits are allowed to build up in the company. That's a key factor in incorporating. I'm just going to go through an example and how it works in terms of figures. So if you're a self-employed trader, your spouse does not have income in his or her own right. You have traded for many years, generally earning between 50 to 70,000 per annum, and have been sufficient for your needs. You have now been given an opportunity to earn 300,000 over 2 years by way of a contract. You still need 50,000 a year to pay your private expenses and mortgage to live on. Should you continue as a sole trader or should you form a company? So if we look at a scenario as a sole trader, if you earn 150,000 as a sole trader, you will suffer tax the first 41,800 30%. The bands in 108 to 141%, so total income tax comes in at 52,722 after deducting your personal tax credit of 3,300. This can be reduced to 49,422. The PSI is 4% on the total, which comes in at 6,000. The universal social charge then is worked out on the first 10 is at 2%, the next 5,980 is at 4%, and the next 83,984 is at 7%. Then the 50,000 is at 10%. So the total USC is 11,319. So the total charge, when you add all the taxes together, comes in at 66,741. So operating as a sole trader on that basis, you have an effective rate of tax of 45%.
Sorry, may I ask, will we be getting a copy of the presentation?
Oh, you will, yeah.
Grand, okay.
Yeah, because it is pretty technical and there's a lot to take in on fairness, so I'm not going to, there's a lot there in fairness.
Thank you.
Okay. So if you look at the scenario then, if you were to set up a company and put that new contract through the company, you'd be looking at a tax of, it'd be looked to be 150,000 contract, 50,000 would be treated as a salary, so you'll suffer tax at 41,800, 20%, 8,241. That gives you 11,722, and after deducting your personal tax credit of 3,300, this is reduced to 8,422. The PSI is 4%, gives you 2,000. The USC comes in at 2,818. So the income tax charge comes in at 13,240 when you add them, treated them together. Now you add to this is the corporation tax on the profits on the 100,000, which is 150 less the 50,000 salary that you paid from the company. That leaves you with corporation tax of 12,500. So when you add that to the other taxes, it comes in at 25,740. That's an effective rate of 17%. So you can see straight away the saving by putting the contract through the limited company.
Sorry, just one thing. You know the tax credits. If you are a director of a limited company, you'd be the proprietary director, and I don't think you get 2 tax credits then.
Well, that would be, yeah, if you want to get into that technical, yeah, that would be valid if you're a proprietary director, but if you own less than 15%,
Yeah.
you would get the credit. It depends on the shareholding that you have.
Yeah.
Yeah. Yeah. As a result of these steps, the 100,000 has not been subject to income tax, PSI or USC. It has been subject to the corporation tax of 12,500, so leaving 87,500 in the company. As a result of these steps, as you can see, 100,000 has not been subject to income tax, PSI. So, but the money is still stuck in the company, and that's the answer to that is yes. So I suppose it's to get it out of the company, to extract it out of the company is the next step. So, but would you rather have 87,500 stuck in the company, which will be subject to income tax if you take it out, or would you rather have 36,499 in your hand after tax? So you can just see there the difference in terms of operating through a limited company or sole trader with that contract. Just some tips there then in terms of a lot we find with clients when they're setting up companies, they might have a certain amount of money to put into the company, so we do advise them from the start, instead of putting money in by way of shares in the company, would be to lend money to the company and take it back as a loan repayment, which avoids any tax implication down the road when the company has sufficient funds to repay the loan. If led into a company, ensure that the debt carries conversion rights so that it becomes an allowable loss if it becomes irrecoverable. So. The next area I'm going to look at is I suppose more the pros and cons of incorporating. So if we look at the advantages of incorporation, the main advantage of carrying on your business through a company are obviously the big thing is the low corporate tax rate, which is currently at 12.5%. This compares to with the marginal income tax rate of 41%, PSI of 4%, and the universal social charge of 10%, depending on the income. A company does not pay PSI or USC on its profits, just corporation tax. Again, there's an incentive there as well. A new startup company, subject to conditions, can get a 3-year exemption, which effectively reduces its annual tax charge of up to 40,000 back to nil. Now, there's certain conditions that has to be met, to avail of that.
What would be an example of those conditions?
Well, the way it works, if you have a profit in the first year, instead of paying corporation tax, one of the conditions is you have to have people employed within the company. So the way the relief works is you'll get back the employer's PSI that you would have to pay on that employee instead of paying corporation tax. So one is offset against the other. That's one of the conditions.
Is there a maximum or minimum number of employees?
I think it's 5. It's the max, yeah. Because it works. I think it's 5. So. The other area of an advantage of a limited company is your pension plan or your pension fund. a company can get a deduction for any contributions made on behalf into your pension fund. See the next advantage. Your company can employ your spouse, your children within the company. Each can have their own tax allowances, PSI limits. So, for example, if the 100,000 was earned by a company and split among four adult employees, the total tax bill would be lower than the income tax charge on one person with married rate bands. The next one there, D, which is always asked when we're talking to new clients or existing clients thinking of setting up a company, about the limited liability. Like, in theory, it sounds great. You protect your personal assets only to a point, because in practice, this is not much of an advantage, because most banks and key suppliers will require a personal letter guarantee to be put in place in an event that is of company debts. So they can follow the directors or the shareholders personally for any money that's not paid. So, like, in practice, it's not as, it's not that much of an advantage, really. If you have to give a letter of guarantee to your bank and your main suppliers. Another area then is group losses. That's where you have a number of companies operating under a group structure. Some of the companies might be loss making, others might be profit making. You can offset the loss against the profits. So that's the advantage there that you wouldn't have as a sole trader. The other area then is the disadvantages of incorporation. Again, the main drawbacks of carrying on a business through your company are, the main one there would be the double charge. This is also known as profit extraction problem. The company pays tax on its profits, that's fine. But then the next step is, as a shareholder or as a director, you have to, if you draw a salary from that company or a dividend, you have to pay income tax and levies on it. So therefore, you could end up paying a tax of 41% on the gain, on which the company has already paid tax. So that's where the double taxation hits. The company pays the tax, plus the shareholders have to pay tax as well if they draw a dividend or a salary. Another area is close company surcharge. Again, if you've a property company that has a number of properties within the company, and the rent builds up within the company and it's not utilised, there's an additional surcharge payable on top of the corporation tax of 20%. Undistributed income of a service company is subject to 15% surcharge. The surcharge, if paid, is wasted money, as you cannot even get a credit against it, against income tax liability when the income tax is distributed. Another area then which is the Schedule E expenses. A company director has fewer expense deductions than self-employed. So you probably know, if some of you here are sole traders, you can put all your deductions in against your income, like light and heat, phone, advertising, all that. A company director is restricted to what they can put through against their salary. Benefit in kind, again, it's a non-cash flow benefit to the company. This can be treated as a distribution of profits liable to dividend withholding tax. Excessive interest is another area that's can be treated as a distribution liable to dividend withholding tax. Another area that's key as well would be the cost of incorporation and annual audit and filing fees that you need, I suppose, work out the cost and benefit analysis of setting up a company. This can run into thousands of euro. There's also time and cost of taking minutes of directors' meetings, loss of confidentiality. You must file your company accounts with the company's office, which can be inspected by anyone. So that's important to bear that in mind. Just to mention then about a small company, the definition, need only file an abridged balance sheet of the accounts. So a company is small if it meets any two of the following conditions: turnover doesn't exceed 8.8 million, balance sheet total does not exceed 4.4, and the number of employees does not exceed 50. So they're the main disadvantages of incorporation. The other area you have to look at then, we find if a client is already operating as a sole trader, they have to look at obviously winding up that business. There's tax consequences for that in terms of if they have been in profit. There's a review done before they can incorporate, and it may arise additional taxes as a result. Also, if they have been loss making up to the point of where they're just becoming into profit now, they have losses there that they might be better using them against the profits before they incorporate. So that has to be looked at. I don't want to go into that too, it's a bit technical, so I don't want to go into too much detail. Another issue that comes up as well is if you have a business that's been in existence for a long time and you want to set up, you want to incorporate, there may be capital gains tax issues around that by incorporating, but there is a relief, what's called retirement relief, if you're over 55, even though you are continuing to run the business through the company, provided you fulfil, there's a 10-year rule that you have to have ownership requirement and that the transfer is bona fide commercial reasons. You can get assets to a value of $750,000 to the company without giving rise to capital gains tax liability. If you're too young to claim retirement relief or you do not meet the 10-year test, you can claim a deferral of CGT liability arising on the transfer of the business to the company. In effect, the value of the company shares will be depressed for CGT purposes, so that when you come to sell the shares in line, there is a built-in gain that will crystallise in the future. Just to mention there, then, if you were to avail of retirement relief, you do not need to transfer the entire business to the company, so you could still run part of it outside the company. If you claim the CGT referral, you must transfer the entire business to the company. Another area that we come across as well with clients is putting property through a company. Now, it has become very popular in the last few years with the crash. Like, there's a lot of companies that are doing well and they're kind of cash rich, and it's a way of extracting money out of the company by buying up property. And I suppose just to look at the advantages of doing that, it's faster pay down of debt. In a trading company, after paying the 12.5% tax, you have 87.5% of profits are available to pay down the debt. This may be an attractive option where the property is to be sold with a business. For example, in the case of a pub, you would find most pubs would be operating as limited companies. So if they're sold on as a going concern, it's the shares that's sold on. So also in that scenario, you might have a group relief may be available to shelter rents. Stamp duty on disposal of shares is 1%. Is lower than stamp duty on the transfer of property, which is 1% for residential and 2% for non-residential. This may be able to enable the owner to command a slightly higher price on the sale of the shares in the company. Again, with rental income in a company, it doesn't avail of the low corporate tax rate. It's actually a higher rate, 25% on tax on rent. It's not excessive if the company is a non-close or if profits are being paid to non-resident. Again, you can set up structures where the money can be paid outside Ireland, things like that. The company can be made to buy unsaleable units at market value. This enables the owner to extract profits. Again, that's very popular at the moment, where you have, particularly in Dublin, where there's a lot of properties being bought by companies, where there's money built up in companies, and it's a way of the owner extracting profits out of the company by building up a property portfolio. Just to follow on again on extracting profits from a company, income or capital, in most cases you will be called for income tax at 41% on your income you extract from the company. If this is taken as given, then it becomes more attractive to extract income in a form that can easily be sheltered. Another option is to extract capital through an approved share buyback. That's where the company would buy back your shares, or just have a completely liquidate the company. Unless combined with retirement relief, such as a capital extraction will be taxed at the capital gains tax rate of 33%. So that's the current rate of capital gains tax. Another popular way or common way of taking money out, extracting money out of companies by way of rent. We'd have clients that would own the property personally and they'd rent it back to the company. You extract profits by renting the premises to the company. If the rent is at commercial level, your company gets a tax deduction and you're taxed on the rent. You can shelter that rent with interest or tax on a tax incentive property, which was very popular back in the boom times, where you had the Section 23 was very popular at that time. Just to go through an example there, for example, say you charge your company $12,000 per year for the rent of your warehouse, say, and you're paying an interest-only loan. Say you're paying $10,000 in interest per year on the loan to use to buy the premises. You personally would only pay tax on $2,000, not $12,000. So that's just to show there an example. Another area that we come across as well is a loan to a company. You can lend money to the company instead of investing in shares. It's more straightforward in terms of the company can then repay the loan without any tax implications. You can also charge commercial interest on the loan. So if we go through an example in this, you'll say, for example, you lend your company 100,000 and you charge 6% interest payable on reducing balance. The loan is repayable in full, say in 12 months' time. Say after 1 month then you need some money back from the company. So the company repays 20,000 to you, say in 10 months' time. There's no tax implications for that because it's money that you lent the company in the first place, so you're entitled to get it back. Just in terms of some traps there, and that would be that if the loan period is longer than 1 year, the company must withhold what's called a standard rate of income tax from the interest payment and remit that to revenue. You get a credit for the 20% tax withheld against your 41% tax liability. Excessive interest is treated as a distribution and is subject to dividend withholding tax.
In those last two cases with the sole trader and the limited company, for lending money to the company or lending or renting a premises, can it only be done by a company, or can a sole trader also do that?
No, it has to be done. It'll be a company structure you'd have to have in place. Well, are you saying if a sole trader lends to
lends money to the trading?
Well, the sole trader is yourself really, so it'll be yourself operating. So it'd be, in a partnership you probably could, if there was more than one. So if you would say two partners in a partnership and one of the partners lent money to the partnership, because it's obviously a separate entity from yourselves, you could operate. That could be done.
Where else would the loan come from if it wasn't from you personally?
If you look at it, you could, I suppose, if from a partnership perspective, there's more than one involved, so therefore there's two partners in the partnership, say, or three. So one of the partners is introduced money to the partnership by way of a loan. It's the same idea as to a company.
So in a partnership situation, you could lend or rent to the partnership?
Yes, correct, yeah. Because a partnership is an independent structure from you because with a partnership, each partner still have to file their own tax returns independently of the partnership, because obviously there's a profit sharing ratio. So say it could be a third each for each partner. So it's the same principle than the company. Yeah.
Just previously it said if I lend money to the company and I can charge interest, how much tax do I have to pay on that interest?
Well, that interest would be treated as income in your hands. So, well,
Is that 25%? Is that normal income?
it's you're asking in terms of if you lend. Sorry,
yeah, it says there.
6% APR. What's the tax?
Yeah, it
for
says
6%?
somewhere you can also charge commercial interest on the loan. You know, say if I as a self-employed person.
Yeah, you'd receive the company would be paying you interest on the loan. Yeah. Well, that'd be subject to the normal income tax rates. Now, what happens is the company has to withhold 20%. That's paid over to revenue.
Okay.
So you only get 80%. But then when you file your personal tax return, you get a credit for the 20% withheld.
Okay.
So it's like a dividend. You'll be still taxed. You'll be subject to the normal tax.
If you put money into a company and you want to take it back out, so there's no interest or no tax. There's no tax, on that money when you're taking it back out.
No.
You can take that out.
You can take.
Roll it to the company, take it out in any way, which way you want.
Yeah, exactly. Yeah.
But if you show interest as an interest payment to be,
Be taxed on the interest.
The would, yes, exactly. Yeah, be taxed personally. Yeah.
But if you need to get out what you put into it.
If you only take it out and you don't charge interest, and then at some point when you take it out when there's money there, there's no tax implication there.
But if you rent a premises, if you have the premises and you're renting it to the company,
Yeah,
you're taxed on that rent.
that's correct. Yeah. The other key area is salary. Obviously, that's the main in terms of extracting money from the company. As a director or an employee, you can take a salary from your company. As an owner director, you'd be proprietary director. You would pay the Class S self-employed PRSI at a flat rate of 4%, and then plus the USC at up to 7%. As an owner director, you must also, as you know, here you have to file a self-assessment tax return before the return filing deadline. Unless you have a substantial non-payaway income, you should not need to make any preliminary tax payment, as the payaway deducted through the company payroll should be sufficient to cover your liability. As a non-owner director, you will generally pay Class A, so you'll be like an employee. PRSI will be at 4% plus the universal social charge will be at 10% or up to 10%. Depends on the income that you'll be on. Your company will also pay employers PRSI at 10.75 on earnings above 356 a week, and 8.5 on earnings below 356 per week. Also, your company must also deduct the payaway PRSI from your salary and pay the amounts deducted each month to the Collector General. The salary is tax deductible to the company. So that's obviously another form of extraction for the company.
Terry, is there any advantage in, as a director, making yourself an employee?
Well, I suppose it depends on there is some advantages, yeah.
Well, apart from being able to apply for job bridge, is there any financial benefits?
Well, look, at the end of the day, yes, you know, the shareholders, if you have less shareholding in your name, there is you may qualify for a different PRSI class, or you may be entitled to additional the payaway tax credit. You'd need to look at the situation, you know, the circumstances.
Okay.
So, as a director of a company, I'm a director of a company and
Yeah.
an employee. But if I go to work in the morning, there's nothing for me. Even if I lost fingers back in '95, I couldn't even get disability benefit because I wasn't paying the right. The percentage of PRSI that I was paying was 2% less than my employees were paying.
Yeah.
Is that still the same case? Joan Burton was supposed to change that back after the last election, which never changed it.
No, that's, yeah, as far as I know, that still applies. That as a director, a proprietary director, you own the company, your PRSI class is S, and that, my understanding is, there's nothing. If you were to work in the morning, you wouldn't be able to claim anything, because you wouldn't be able to claim, say, an employee can claim that stamps back through job seekers benefit, but you'd be means tested, so you may end up. We had cases where directors were, when the downturn came, they came into us and they didn't realise that they were entitled to nothing, and we went through it with them, and they were means assessed, and some of them got something, some of them didn't get anything.
Isn't that what they should make themselves an employee?
They are employees.
Well, they are employees of the company at that point.
Can you not say in your case, Mika, can you know what kind of company it is?
Furniture.
Furniture. So if you're a director, but you work basically as a carpenter, can you not? But you'd have to pay Class A stamps then.
Class A. Well, you'd have to look at the whole structure of the company. Like I assume.
You pay yourself as a director and as an employee, as a carpenter, you know, because that's not really. I think you can do that.
Well,
Too small ones.
you have to, well, if you're a director, yeah. Well, most small companies that we operate would be director owned, so they'd own 100% shares. So you'd have to restructure that side of it, you know, in terms of trying to work out. But
So you'd have to stand back completely from
you'd have to stand back, because really that if you anyone here that's a sole trader will probably know themselves, they're paying S class PRSI. So as a proprietary director, you're paying the same stamp. And
Just again, why can you? Because I'm a director and I'm a PAYE employee and I'm also self-employed.
yeah.
I'm a PAYE employee with another company, you know.
Mm.
Something else.
Oh yeah, if you work for a separate company, you
Yeah.
can avail of the A class in that case. Yeah. If you're receiving to work for
But if you're
another company.
working as a normal employee like a carpenter, he's not paying himself the director's salary as the director, as, you know, as the managing director. I think there is a case you could make to revenue that you can.
Yeah, well,
You have to pay the full PRSI.
Yeah.
And then you would qualify.
the company would have to pay the employer's PRSI, yeah. Because as an S class, there's no employer's PRSI paid over.
Then you're not getting it. But I think you can employ yourself as a carpenter and pay the full PRSI, and then you qualify for your.
Yeah. But you see, if you're connected with the company, they're very strict in terms of the S class and the A class. Like it's an area we have come across it, but it does go to what's called a scope section, and they'll determine a definitive answer on it.
How much of the company can you own and still then register with the ordinary PRSI? I mean, if you don't own 100% of it, if you're a director.
Yeah.
How much of it can you own and still become POI there?
I think it's 15%. I could be corrected in that now. So if you have less than 15%, you can retain your A class.
It's like claiming if something happened to me, you might take the fingerings. You have to prove yourself negligent. When you're a director of a company, you can't really prove yourself negligent.
Yeah, I suppose.
In the insurance of the company, because you're not insured either.
Well, you get nothing back in the PRSI. I suppose you could talk to Barry. He could sort out maybe income protection. That's not being smart, Stephen, but that's a lot of directors have that in place. Because in reality, I have it in place. You have to, because if you do get sick in the morning, there is no comeback, because there is absolutely nothing from the S class in reality out there.
And how would it work then for a pension when you get will it be paying towards, when you get on to 66 or whatever it is, will it qualify you for a contributory pension?
It will, yeah. The S class entitles you to a contributory pension. Provided you have enough stamps paid, you have to have a certain number of years paid. Just to follow on from that, another area is benefit in kind. Again, your company, you can give yourself a company car from the company, other benefits, and allowing other benefits, and these are usually taxable as part of your director's salary. Not taxable are free bus or train tickets, subsidised on-premises creche facilities, travel and subsistence expenses paid in line with civil service limits, employer's contribution to an employee's pension scheme. They wouldn't be subject to benefit in kind. Dividends, you can also pay yourself a dividend from the company. However, unlike salary, a dividend is not tax deductible to the paying company. So it is a payment from after-tax profits to the company shareholders. So it's where if the company has X amount profit at the end of the year, you could pay yourself a dividend, but it's not that tax efficient to do that, because obviously if you pay yourself a salary, the company gets a tax deduction for it. Just to bear in mind, then, a company that is legally restricted from paying a dividend if it does not have sufficient distributed reserves. So you're prohibited under the Company Act or Company Law.
So just on the expenses side, isn't it more advantageous to be a limited company than a sole trader? You that a sole trader gets what they spend, but a limited company will get civil service rates.
Yeah, exactly. Yeah, there would be the kind of veil of. Again, it depends on the type of company. If you've come to there's a lot that the directors are on the road a lot, doing a lot of travelling, and they have to be out. Obviously, it might be more beneficial to claim the travel and subsistence under the civil service rates as opposed to the actual expenditure.
But isn't it a way to draw a percentage of your earnings tax-free?
Oh yes, it is. Yeah, once it's a valid claim, it's tax deductible in the company's accounts, and then it's not taxable in your hands.
And is there a thing coming in now that if you say you were to an MS, have a company, and I am going to the same place of work, I have a contract with, say, Intel or with whoever, I'm going to the same place of work every day. Now they're saying that you can't claim expenses from your home to that place of work. It's only when you move from that place of work to another place that you can claim the expenses. Yeah,
the general rule is you can't claim expenses from your home to the workplace, but from your workplace to different sites or different clients, you can claim expenses.
But if your contract is with another company and you're travelling to that company. But if you keep going to the same company every day, even though you have that job priced as you were in there privately, it's a priced job. They're going to stop that you can't claim the travelling expenses from your place of work to their place of work.
All right, yeah. I know that's under review because it is an area of revenue you're looking at, that whole area of motor travel and subsistence.
Yeah, but some people are walking from their house to the office and then driving on to the contract.
Yeah.
They actually opened up an office outside the house to claim that they were actually going from the office to the contract as opposed to the house, even though it could be adjoining.
Well,
that's why I think they're beginning to review it.
They're clamping down on it because it's obviously it's like, I suppose in practice we find is that where there's an audit carried out in that area, if there's an excessive claims put in, the revenue are going to, they're going to review it, and they're going to. We have come across situations where claims have been excessive and to have put it through. We had to put it back in as a salary and regross it. It has become very costly for the company. After when you
politicians, they get paid as soon as they drive out their street. They take the claim expenses from there wherever they go.
Yeah. To be honest, it's a grey area at the moment. It's not like the revenue claiming, they come out on site to you, they're claiming the rates, from their. So it depends. It's an area that's not that clear in legislation. So
yeah, but like
the main thing is that if
people that's gone over the 50% mark or even 40.
Yeah. Well, if you have a salary of 50,000 and you have expenses of 40, that's a problem. Like, the general rule, you wouldn't want to have your expenses more than 50% of your salary.
If you take a councillor there, he has a salary of 25,000 and he has an expenses of 65,000. That's
Yeah.
But it's completely different.
Who is that?
County council would have had salary of
But it's
25,000.
not company. I'm not saying it's right or wrong, but it's not, they can go over 50%, it's different.
Yeah. I suppose all I can say to you is that the main thing is that you have proper books and records in place if you are inspected, if you are putting through mileage claims.
Could you just clarify the situation with regard to being a sole trader working from home and say one room in the house is converted to the office? Can you charge the company rent? Or you convert a garage, for example, into an office. Can you charge the company rent? If you can, what are the pros and cons, or if you can't?
So you're saying if you operate as a limited company and rented one of your rooms in the house?
Sole trader. So you're a sole trader working from home, with one room in your house or your garage or whatever is your workplace.
Yeah, look, I'll come back to you on it. I wouldn't have that.
Okay.
I can give you my card and you can give me a call on it. We can discuss it.
Just conscious of time, Terry.
Yeah, I'm nearly there now.
But is it really a per case basis? I mean, I had the impression that it's really down to amounts, but it really is like when you hit whatever 40, 50, 60k a year, you should consider the limited company and.
Well, you can see there, not necessarily.
Yeah.
Do you know, it depends. Like, it depends. Every business is different. Some businesses are suited for limited company and some aren't.
11%, I'd say, are
what's it, just
no employees.
right?
Not to exclude, but just if we have a show of hands for just people with no employees.
What did you say, Jen?
People with no employees.
Yeah, she was nearly half.
So it's what would you be saying to people with no employees? Is it still on a per case basis, or is it surely it's a turnover when you're on your own to go from sole trader to limited company, excluding liability, or is it?
Well, again, it's down to the tax really, and what, like, obviously the company, based on the current rates of tax, it's the most efficient way to operate because, as you all know, anyone that's operating as a sole trader, like, they're being crucified for income tax and levies, and the USC, as you know, is a very aggressive tax.
So you suggest limited?
Well, I do suggest it, but you have to watch the level of drawings. Like, if you're used to living on 50,000 of a profit, say, from the company or from a sole trade, you'd have to like the company only work to the point where you can live on that salary, but don't draw any more out. You know what I mean? Because if you end up drawing out all the money out of the company, you might as well off staying the way you are, because you're going to end up paying the same amount of tax. The company is useful from a point of view of growing, say, as a savings box, and if you were to let the company grow and let the money stay in the company, and maybe down the road, if you wanted to diversify or develop into new areas, that there be sufficient working capital in the company. But if you want to draw all the money out every year, you might as well off to stay the way you are as a sole trader. Just really depends on your circumstances. It depends on the type of business and what you're involved. You know, that would be a deciding factor. And as there's areas there, the level of drawings and things like that are key factors.
Okay.
A loan from a company. This is the other way around, and if your close company makes a loan to you as a participator, it must withhold income tax from the amount of a loan and pay income tax to revenue. Again, this is a big area at the moment. We have a lot of companies that's personally they need money and they're drawing the money out of the company. And what's happening is, when we come to finalise the accounts at the end of the year, they're overdrawn in the director's loan, and they have to either pay back or else put through a salary, or else and they usually don't have the money to put back into the company. So therefore, in that case, the company has to deduct income tax from it and pay it over to revenue. So that's a big area at the moment. So just in terms of that, if there's a case of that, if a loan to a full-time director or an employee is not caught for this 20% tax, if the total amount is less than 19,000 and the person does not have a material interest in the company, which is, i.e. not able to control more than 5% of the company's share capital. Just to make the point that there is no tax advantages in taking a loan from your company. Penalties for not paying income tax deductible can be severe. So that's a big area of revenue looking at the moment, where directors have overdrawn their directors' accounts and they effectively can't pay it back. So it's an area that they're looking at. A loan, just to make the point, includes any form of credit from the company. Approved share buyback. Again, that's an area that if your trading company can buy back your shares in order to benefit the trade, in doing so, the payment of the shares is treated as capital gains in your hands. Again, instead of taking it out by way of a salary, it's subject to conditions. Your gain would be subject to 33% as opposed to effective rate of 55%. So that's another area. Then, in terms of winding up the company, a company can be wound up for several different reasons. But an example there is if your company permanently ceases business. Say, for example, that contract I mentioned earlier was a 2-year contract and it wasn't renewed, so you had 100 grand in the company. So you decided, look, I'll call it a day. I'll just wind it up. So if your company, in that case, it'd be wound up voluntarily. So each shareholder would receive repayment of his or her initial capital investment that they put into the company. And any growth in that investment is taxed in the hands of the shareholder at a capital gains tax rate of 33%. So thank you for your time, and it is a pretty comprehensive document. It's a lot of practical issues that we be dealing with on a daily basis with clients. So, but I would suggest if you are thinking of setting up a company, definitely seek professional advice before you do, and just weigh up the pros and cons in doing it. Okay, thank you.